Hello, chart watchers, and welcome to Market Watchers Live with Aaron Swenlin and Tom Bowley. I'm your host, Tom Bowley. Today's show is being recorded, so you should be able to play back any or all of Market Watchers Live at your leisure. If you're unable to attend the show live, you can now go to www.stockcharts.com/webinars. Follow the link to Market Watchers Live and play back the show. Each show will be archived on our site until the next show begins, so you'll have roughly 24 hours. If you'd like to review an older program, you can now find those at our YouTube channel or on Facebook. During today's show, please feel free to submit ticker symbol requests, questions, and comments using the chat window next to the video player. Later in today's show, Aaron will provide me stock symbols from those questions, and I'll use your requests in the 10 in 10 segment at 12:50 Eastern Standard Time, where I'll attempt to annotate 10 stocks in 10 minutes. Market Watchers Live now airs 5 days a week, Monday through Friday, from noon to 1:30 p.m. Eastern Standard Time. If you'd like to be part of the show, you can reach us via our chat room or Twitter. Our Twitter handle is at Market Watchers Live. That's at MKT Watchers Live. As you leave today's show, please fill out the survey. We'd love to get your feedback. In the lower right portion of your screen, you'll see a How'd We Do section, and there's just a link there to a very, very brief survey. Let us know what you think of today's show, and provide us any suggestions to improve the show. For those of you joining us for the first time today, welcome. We're glad you're with us. And for our regulars, welcome back. A couple of quick announcements. We have Greg Schnell in the house today to talk about point and figure charts. Aaron Swenlin will be discussing chart patterns on Friday, tomorrow. So make sure you mark that on your calendar. Also, I want to make sure everyone is aware that next Thursday and Friday, there will be no Market Watchers Live. So the Thanksgiving Day holiday, of course, the market is closed on Thursday, and there's an abbreviated session on Friday that ends at 1 p.m. Eastern. So there will be no Market Watchers Live shows next Thursday and Friday. And with that, I'll bring in my co-host, Aaron. How are you doing today, Aaron?
I'm doing great, as usual. Interesting day in the market. Looks like we might be getting a little bit of a rally pop here. We'll have to see if it can hang on till the end of the day.
Yeah, I mean, it's been kind of strange the last week, 2 weeks, where we keep seeing the gap downs at the open. And then we've actually gotten some pretty decent movement back to the upside after the early morning weakness. And that's been pretty consistent over the past couple of weeks. And today we got the big gap up. A lot of news out there. We had really strong results, earnings results that came in. And we'll talk about some of that in just a little bit. But I'm going to let you go ahead and get into the agenda and that first market update. And we'll be bringing Greg Schnell in here in just a bit.
Absolutely. So yes, market updates on the half hour. Talking technically, Tom and I have a few things we want to show you. And then we're going to be bringing in Greg to do point and figure charting for all of us, how we can read them. And then what would you do? We're going to do that segment, and we're going to be looking at XBI, the biotech XBI is materials. So we're going to look at that particular sector, Spider, and then we're going to ask you what you would do, and we'll tell you what we would do. And I'll be putting a Twitter survey up there as well today. 10 and 10 to 1, and the first symbol we're going to look at is HYG. So if you want to take notes on that before we get to the 10 and 10 to 1, then we're going to look at a couple of blog highlights for you and finish up with mailbag and wrap up. We'll see if we have time for some of those questions that pop up in the chat box. And with that, I'm going to take us to our first market update. And away we go. Here is our candle glance. I'm actually going to update it here just to make sure I've got the most recent action. And here we go. So yes, we've been looking at gaps down and then recoveries. Today we've got a gap up and then more rally. So we're getting a continuation on the gap that we're getting in the morning. So that's great to see. Right now we can see most of the indexes are flirting or reaching their intraday highs already this morning. And Russell 2000, we've been watching small caps really suffer, but we can see that they have taken off today. And, well, you could make a case for a flag formation here on an intraday chart. Wilshire 5000 also moving up. Notice that Treasury yields are rising at this point. We've got it at 23.54. UUP mostly unchanged, but staying in the positive as well as gold, also in the positive here, but mostly moving sideways. USO, really interesting trading day so far. You know, we moved way down here and then we had a really great rally, and now we've come almost all the way back down to intraday lows. I'm going to take you quickly to our market summary, and we can get there. There are two ways. We can click here, or if you want to go over to the right, you will find market summary. So I'm just going to click it right here. It's quickest and easiest. And then we're going to sort by percent change. And what I wanted to point out was, if you look at our major indexes, the small caps are really making the best move at this point today. And so that's really good to see. We haven't seen small caps participate. If anything, we've seen them suffer more than most of the other large cap indexes. And as we can see, as far as sector spiders, consumer staples, technology are leading with over 1% gains, and energy utilities are the laggards, the only sector spiders that are in the negative. And with that, I'm going to complete our first market update. But before I hand it over to Tom, I did want to share with you, since we're looking at the small caps, and I'm going to write about these in my blog tonight. But I actually have my DP indicators for the S&P 600, and I just wanted to show you two of those charts because, you know, we're getting ready, it looks like, to hit lows, get into that oversold territory on these intermediate term indicators. And when you see those turns, those bottoms on these indicators, typically you're going to be getting a nice rally off of those. Typically, of course, we did get a rally off of this particular low, but then we, of course, had to suck it up here for a decline, and then moved up for that rally. And then the other one I wanted to show you. So we're at a turning point, I think, for small caps. And then I also have a McClellan oscillator for the small caps. And I thought this one was very interesting because, as you can see, we're getting very oversold as far as the McClellan oscillator, but it is also still declining, as is the summation index. So we're not quite there according to the indicators, but if we start seeing things turn up, and we are in oversold territory, so I think this is a great place to see the S&P 600 bounce off of support. So that's what I'm looking at, Tom. I'm really interested in these small caps and seeing them turn around, and seeing these indicators in that oversold territory are getting ready to turn. I think does tell us that this area of support here at about 875 for the S&P 600 could very well hold as support and be the launch pad for a new rally for the 600.
Yeah, I would agree with that. I know I had written earlier, and I provided a couple of really key areas on the Russell 2000, which is another small cap index. And what I was looking for, there were a couple of things. Number one, we'll have the daily chart up here, and I'm going to get into some economic reports here in just a minute. But if I annotate this chart and we take a look at the key price support level, this was the breakout that we saw back in late September, and we had that parabolic move, really short-term parabolic anyway. And notice that the pullback, we came all the way back down essentially and tested that price support level yesterday before having the big rally into the close yesterday, and then another very solid day today. So we've moved up about 30 points on the Russell 2000 since early yesterday, and that's over 2%. That's a pretty nice rally, and I would not be surprised to see this also, as you said, kind of be a launching area for it. The other thing that stood out to me, and there were really three reasons why I thought this 1450 area on the Russell 2000 would be pretty strong. The second reason was, if we take a look at the Fibonacci retracement levels, you'll see that off of the low that was established here in mid-August, and then that huge rise that culminated with the early October high, really we couldn't get back through that. The MACD started rolling over, so it just showed a little bit of signs that rally was maybe needing a pullback. And the first level of support under Fibonacci was at 1451, and we got down as low as 1454. So we got pretty close to that level. And then finally, looking at a longer term chart, let's see here. Going into the weekly chart, if you take a look, I like anytime I see a 50 period test and the MACD get close to that center line, when we start rallying again and breaking out, I then use the rising 20-week moving average as support, and that happens to be at 1454. And that was exactly the low yesterday. So I think, there are multiple reasons here that suggest the small caps have hit a bottom. And I'd throw a fourth one out there too. If we take a look at the seasonality chart on the small caps, and I'll drag that back 20 years. I can tell you, even beyond the 20 years, this holds true. But check out December. The average monthly gains in December, 3%. And really, from the fourth quarter, the start of the fourth quarter on, we just see this continually build up, the historical gains. October averages 1.2% over the last 20 years, gain on the Russell 2000. November's 1.9%, and then December 3%. And you can see that December, as far as the percentage chance that that month is going to end higher, over the last 20 years, December's ended higher 79% of the time, which is, roughly 4 out of every 5 years. And going back the last 20 years, you can see that that is the best month in terms of the chance that it goes higher. And so here we are, middle of November, in a pretty bullish time of the year, getting ready to head into that December period. And it looks like the small cap stocks are starting to make that turn that we normally would see, and that the strength that we normally see in December, I think, certainly appears like it's just around the corner. So all of those things, I would agree. Small caps do look pretty interesting. Of course, now after we have a big move, it becomes a little riskier proposition. The whole idea with managing your risk is you want to try to get in close to that support level. And yesterday's low certainly gave us that opportunity. Couple of items here. First, initial jobless claims came out today, 249,000 versus an expected 236,000. So a little bit higher than expected. The November Philly Fed survey, 22.7. Market was looking for 25.0. So again, a little disappointment there. October industrial production at about 9:15 this morning, that report along with capacity utilization came out, and both were hotter than expected. Industrial production was up 0.9%, and the market was expecting 0.5%. And then capacity utilization was at 77%, and the market was looking for 76.4. And then at 10 a.m., just a couple of hours ago, we saw the November housing market index come in at 70, and the market was looking for 67. So from 9 o'clock on, we got some pretty solid economic news. I think that has helped to spur the rally. I think another thing that's helped spur the rally, I believe it was, let's see where we are now, the EWG, which tracks German shares, and you can see the bounce. I'm going to show you the DAX, but the DAX doesn't include today's data yet, so I wanted to show you the EWG so you can see that that rise is about 0.6% today. And now let's pull up the DAX, because I thought the DAX was at a pretty important level yesterday on this move down. You actually look at that reversal. We had been down about 6-7 days in a row, and we went down, hit the 50-day moving average for the first time in over 2 months, and had a beautiful reversal, got back up, closed near 13,000, and held this recent area of support. And I'm going to annotate this really quickly. But you can see right there, that was the resistance level. We broke above. Notice we continued to hold it. And look what the action yesterday did. The DAX went down below the 50-day moving average, below this price support line, and then recovered back up. That is a reversing candle off of this downtrend. And the main reason I like to watch Germany is that I think the correlation between the German market and the U.S. market is the strongest out there. Based on using the correlation indicator here at Stock Charts, you can see that the two do tend to move hand in hand. Not every day, but knowing that Germany posted that big reversal and is up today just gives me a better feeling about what I can expect from the S&P 500. So I thought all of that was pretty good news. Did want to mention a couple of earnings reports before we bring Mr. Schnell in. WMT, Walmart, came out with very strong numbers. I think they beat by 3 pennies on the bottom line. The market, you can see, really likes it. Not only are we getting the gap up, but we're seeing continuing movement to the upside. And check out the volume. Already 20 million shares, over 20 million shares today. We're not even the halfway point of the day. So this is going to be one of the strongest volume days on Walmart in 2017. And you can see very bullish action, price action, confirming this breakout to the upside. So I think that's awesome. Cisco last night after the bell came through with excellent earnings. And you can see after kind of, I don't know, maybe absorbing some of the gains that we saw from August through October. We'd kind of been going sideways, maybe in a little bit of a flag pattern here, but we clearly broke out today, and again on very strong volume. Network appliance, this stock has been a monster, and it continues to be. Big gap up today again. Very, very heavy volume on this gap up. So network appliance also doing really well. And with that, I am going to bring in Mr. Schnell. How you doing today, Greg?
Hey, Mr. Boley, I am good. And that move on Walmart was huge. That is a big kickoff going there. And am I mistaken? Is Walmart in broadline retailers or is it in consumer staples?
I think it's in the broadline retailers along with Amazon.
So
yeah,
it shows
that's a big move.
Discretionary group, but in some ways it's more like a grocer where it's also consumer staples. So anyway, I'm interested in that one. Really a big move, and obviously lots of interest on that earnings breakout. But I think their online segment is also, they're working hard to kind of pick it up against Amazon. So that's an interesting chart there.
Yeah, that definitely, it's a very, very strong reaction. And the thing is, there was a lot of good news built into this report as well. I mean, you can see the stock trending up for this, 6-7 weeks prior to earnings, and doing so at least part of the time on some pretty strong volume. So I see accumulation in the stock even before today's report. And I think you got a bunch of other folks jumping in now. So this is a type of stock I think is very bullish. I wouldn't chase it. I mean, it may continue to go higher, but I would definitely be looking at this on it or during any period of weakness over the next few weeks.
Yeah, I would agree that it's probably a little late to chase that rocket, but if you could get a pullback into the gap there, that'd be nice.
Yeah, 9% on Walmart's pretty steep. I mean, there's some companies that could go up 9%, and the next day go up another 9%, and maybe Walmart will do that. But Walmart is, been around a long time, and it tends to be a slower mover than that. So, yeah, it would be difficult for me to kind of chase this move to the upside. But anyhow, I know you're joining us today to discuss the point and figure charts, and I know we got a lot of folks here wanting to learn more about that. Maybe a refresher for some. But what do you have for us today?
Well, let me grab the screen. Hopefully you can see my PnF charts. So it should
small, but I got you.
Okay. Yeah. So one of the problems with the PnF is it doesn't actually scale well to the width of the screen here. Let me just show you that I can zoom this way out, which is nice. The problem is that the screen is way down here. So I just want to show people, first of all, the scale on PnF chart. And you can see this 17, that is for 2017. So that does not, we don't get into the exact day of the week or anything like that. And if you, sorry, I'm going to scroll a little bit here, but up at the top here, you'll notice that we have the letter A showing, and you can see here's A, just go down a little bit. Here's B, then C, 1, 2, 3, 4, 5. So what those are is those are the months of the year. And so we start with January as the 1, 2, 3, 4, 5, 6, 7, 8, 9. So what that means is in January of last year, this was the first box that got an X or a price change enough to make the box move. We are in the middle of November and there is no B yet. So October is A, and there is no B yet because the price has not moved all the way down to make a 3-box reversal. So we don't have a letter B showing up, even though the S&P has moved around quite a bit, what we think quite a bit. The key thing about the PnF chart is it takes out small movements that are really not big enough to change the trend. So first of all, PnF removes time from the equation. The closest you get is just a monthly indicator, and that's what these little red letters are. So again, 1 through 9 is September, and then A for October, B for November, and C for December.
Hey, Greg.
Yep.
Just to clarify, I noticed back near the 1, right before that 1, those 3 circles.
Yes.
Anytime you have the pullback, you're always going to start with the 3 circles, correct?
Yeah. So what has to happen? So the price will continue to move in a direction, and as long as the price doesn't reverse at least 3 boxes, so not including the box you're on. So in this case, we hit 2270. Now, until we hit at least 2280 exactly, it will not make another box. So then what happens is the price is wobbling around, and it might go all the way up to 2279.99. Until it hits 2280, it will not make another box. So it sits right up against resistance. It could go all the way almost a full $10 higher, but it will measure from the low point here. So from 2270, it has to go all the way down, and it has to hit 2240 exactly. So not 2249, not 2248, 2240.00. And until it gets down that far, it will not make a reversal. And then all of a sudden, all three of these would show up at the same time. So it continues in an uptrend, and it will give the stock some movement up and down. And as long as the movement isn't enough to create what we call a 3-box reversal, then the price will hold. So a column of X's is rising prices. A column of O is falling prices. But the big thing to remember on PnF is it takes out time. We don't get into each day of the week, and it takes out insignificant moves. So as long as the price doesn't do what we call a 3-box reversal, then you're still considered to be trending one way or the other. The charting automatically puts a trend line on here, and you can see we're well above trend, and much like the S&P is well above its 200-day moving average. This support for the long-term picture on a PnF chart for the S&P 500 is way down at 2250. I mean, this is a huge bull run, obviously, and has been running for a long time. So there's two things to remember about PnF charts. It makes support and resistance quite obvious, and it makes trend lines very easy to draw. Now, you could see that we could easily draw another trend line, up in this region here. But the PnF chart automatically draws these trend lines. And I'm going to show a bunch of different charts that will go through that, and we'll show you how that works. So first of all, let's cover off the concept of support and resistance. So way back in 2016, the market was falling. And so we had a falling market, and this is probably January, February 2016, where we start to make a low. And we're still in a downtrend even as we're bouncing out of there. So you can see February's over here. And then we come all the way down, and this is the 1st of March, or this is the month of March showing up here. But as we came up, we tried to break through this downtrend. We actually got one box above it. And normally the chart won't change for one box above. It won't put the blue line. It would just kind of show an exaggeration. So if the trend continued down, it would continue the red line above this one. And I'll show you some other charts that have that feature on it. But in this particular case, we basically went down, tested just below support. So we fell down one more box, and then we reversed higher. And here we took out the previous high. So remember, a column of X's is rising. But at this point, the market rolled over and came back up. When we went above the previous high, that would be our first indication there might be a turn. Now the market continued to rise up and went back to the previous highs. And so this previous high is an important resistance area on any chart. So if we switch to a candlestick chart or a bar chart, the previous high would come into play. And the way we identify a rising market is higher highs and higher lows. So until it breaks above the previous high, we don't have a higher high. So we roll over, and all of a sudden the price got up to, let's call it, between 1940 and 1950. It was up in that range, and then it rolled back over, came all the way down to above 1900. And then it reversed and started climbing out of the hole. When we made this X right here, we have broken above resistance. And so we would call this a triple top breakout. So we had an X, another X, and this becomes a triple top breakout. So we head up from there. And early in March, we made this move. And the only reason I say early in March is because we continued to put on a lot of boxes after that. So we moved up, and you can see we just did a brief 3-box reversal and headed up, but we continue to make higher lows and higher highs. When we went past this downtrend line, immediately it would draw this line up here, and that line is in place and just sits there. It doesn't change trend. It's always just drawn at a 45-degree angle. So we continue to rise up, and then March and April, continuing to climb. This is 2016, so it was a pretty bullish year, and we're coming out of the hole. And then June, we had a bit of a pullback, and we actually broke through previous lows, and so there was a lot of worry or consternation that the market was starting to break down. Sure enough, we reversed, and we didn't just get back to resistance. We went all the way back up through previous highs, made new highs, and then in September we rolled over and kept working our way down. Here we had a great support and resistance level. So you can see on the left we have X's that had kind of stalled there, and we had O's that came down to meet that same level. So this is where we would draw a traditional support and resistance line on a chart. And then we broke down through it and wrote the word boo there, Halloween scare or something. And then we took off to the upside and continued to rise. So you might remember this was the November low. So B is November. So we fell down, and then we went on this huge bull market run that we've been on ever since. And so as the market works its way above previous highs, you've got a double top breakout or a triple top breakout. When you have those breakouts, that's very bullish. And so on the scan engine, we actually have automated scans for the PnF charts, and I'll show you those in a little bit. But the concept I want to make very clear is that when you're breaking out above a previous column of highs, you're in a new bull uptrend. And when you're breaking below previous support, in this case, the column of O's, this would be a new downtrend. And so the problem you have in a PnF chart, unlike when you measure a stock just above or below the 200-day moving average, it's one area. In this particular case, this is the previous high. This was a previous high, so we're in a downtrend here. When you break below this area, the stock actually has a whole 40 points to move, or in this case, the index has 40 points to move before it actually will go on a sell signal. So you were on a buy signal because it made this column of X's. Even though you make a new column of O's, unless you take out the previous low, you haven't made a new sell signal on a PnF chart. You're still in bull mode at this point, even though you're in a column of O's. So the previous high was now 2170, so it was here. We went on a buy signal when it broke above. Now we come back down, and as long as this level of O's holds, you're still on a buy signal. The market is declining, but we're still on a buy signal. And until you get this first box down here below 2120, that's your first sell signal. So at this point, the chart would go on a sell signal, and you can see it was just enough to shake everybody out and turned around and reversed right away. So, so you get this reversal and you break out. At this point, you go above the previous column of X's. So you don't have to get back above this one. You just have to get back above the next column to the left. And so when you go above this X right here, you're now back on a buy signal. Why is that important? Well, when we get into the bullish percent indexes, which use PnF charts, that's what it's comparing. How many stocks are making a higher high compared to the last row of X's? And as long as you're in a bull market trend, a lot of those stocks will appear. So on my commodities countdown recording, I usually have a lot of the PnF charts or the bullish percent indexes in there. And that's what it's trying to measure, is what percentage of stocks are on a buy signal. And as an example, I think most of the markets, the NASDAQ, the S&P, the New York Composite are all around 60 or 70%. So the majority of stocks are still on a buy signal. If we look at this S&P 500, even all of the consternation this week with the market pulling back hasn't even been enough to create a column of O's, let alone take out this previous low at 24. We'd have to get to 2449.00 to get down to put an X in this box. And then we wouldn't get a lower X until we got down to 2440. So, you know, we're at 2585. We need to move 180 points for this market to reverse to a sell signal. That's a long way. So very bullish on the market here, and we continue to move to new highs. Now, I just want to show you how the scaling works, because it auto scales the boxes on the right-hand side. And so I'm just going to run through some indexes here to make sure everybody understands that. So first of all, let's look at the Dow Industrial, because it's got a number starting in the 23,000 level. What you see here is the numbers are scaling up by 50 points at a time. And so on the S&P chart that we just saw, they were scaling up by 10. The boxes were each 10. Now this is almost 10 times as big as the S&P 500, but we're doing, the box scaling is 50 boxes, 50 points per box. So a reversal needs at least 3 boxes or 150 points. So yesterday we had a low down here, and that was an intraday low. So because you're in a column of O's, it would continue even if the market reversed enough yesterday to make the turn. The first thing it was in a downtrend. So if it made a lower low, it would continue to make that and record that for the end of the day. Today, we're getting 4 green X's. And the reason for that is, first of all, we've had enough price move to get us a 3-box reversal plus 1. So we're all the way through 23,550 at one point, and then that gave us our high, and now we've pulled back somewhere in there. But it will close the day now in an up column because we've actually reversed the turn. And if the market rolled over again tomorrow, then we would just start to make another column of X's, or sorry, of O's. But we broke support, so we went on a sell signal. So even though we're on a column of X's, we're on a sell signal on the Dow Jones Industrial, unlike the S&P 500, because we broke this previous column of O's. And so now we're trying to climb up here, and there's a little bit of resistance at this level from a previous high, and there's a little bit of resistance up here at, the all-time highs. So as we watch this market, we're on a sell signal on the Dow Jones Industrial because we made a lower low here. We won't be on a new buy signal until we go above this previous X, or until we get to 23,650.00. We have to get exactly to that number or higher in order to put an X in that box. So it's very important to understand what we're talking about when a buy and sell signal. So even though we're on a rising column of X's, we're on a sell signal because of this lower low. Okay, hopefully that's clear. And if not, you can put that in the chat box and I'll try and see that.
Hey,
Okay.
Hey, Greg.
Yeah.
Looking at the S&P 500, when you had that up, there were 10-point intervals, and then you pull up the down, they're 50-point intervals.
Yeah.
Can that be adjusted?
You can adjust the box size, but the big thing is as the numbers go higher. So obviously, if you're working with something with 23,000, would you want a box size of 1? I mean, it would just make the chart way too unmanageable. So the idea behind the auto scaling is it tries to take, small percentage moves in each stock out of the equation. And so that's the whole idea of PnF. So I would say you can adjust it. And if I'm going to show you how to go to 60-minute charts and show you that too. But the big thing is when the scale is so different, you really do want those insignificant moves to take out. And if you adjust the scale, let's say for the Dow, you adjusted it to 10 points. Well, the Dow's up 150 today. That would have given you 15 boxes today. And so that level of change is just way too much. Each day, the chart would look like a yo-yo with these huge runs of 300, 400, 500 points and then huge falls of 200 points. It makes it unmanageable. So in order to do this, they started to scale this. Now, the original work with PnF charts was in the commodity trading floors. When something would break to a higher high, and this month we've had crude break out to a higher high. When we look at that, basically that is a new bull market for crude oil. And until it goes on a sell signal, we're on a bull market signal for crude. So it's that change in scale that shows up, and crude's at $57. So we don't want a 10-cent scale there, but we've got a $1 box size, and I'll show you that right now. Okay, so here's S&P 500 with 10. Let's go to the Russell.
And the reason, by the way, I asked about that is the S&P had 10-point at 2,500, had 10-point intervals. And so the Dow at almost, we're 23,000, which is almost 10 times that of the S&P. You would think that would be a 100-point interval, but it was only 50.
Yeah.
So that's why I was wondering. It was different percentages for the two indexes.
And it's not a percentage-based change, and we can set the box to percentage, but in this particular case, it auto defaults to put these particular numbers in place. So here is the Russell, and we're on a sell signal on the Russell. If we got above 1490, and we're at 1487, if we could get 1490.00, we would now have a 3-box reversal, and we would get up there. So We're very close to getting a buy signal on the Russell, but we're not there yet. Now, I want to show you the NASDAQ, and the reason is because it's on a whole different scale. And
is there any time, Greg, that you would deviate from the traditional settings that are set there? Or are you pretty much
use percentage, but I would say to start using PnF charts, just use the default settings because they work really, really well. And I'll get into how they change. And on the Chart School article, it tells you exactly what levels the price boxes will change. But here's the NASDAQ at 6,300, and you can see we're still at a 50-point reversal. So even though we're nowhere near the Dow at 23,000, we're still using a 50-point reversal. Okay, we're on a buy signal. We've had no sell signal at all in November on the NASDAQ 100. And our last signal was right up here with a new high in the NASDAQ in November. And you could see, 6350 would just push this chart right to the top. So as long as the market continues to perform this way, things are going pretty well. Okay, now let's get rid of this. And I just want to show you a couple of other stocks. So Netflix, everybody might be familiar with the company that's in everybody's living room every day. We can see that this stock here has a $2 box size. So here's $1, $190, $192, $194. But look what happens right at 200. It goes to a $4 change and then another $4. So because you've gone above 200, your box size has now changed. There's no magic line on the chart. There's no shading on the chart. There's nothing to tell you that. You just have to observe that the chart has now moved on to a new scale. So in PnF world, and let's face it, if a stock moved from 204 to 200, you're at 2% of the stock. This isn't a huge move and probably not something that you want to buy or sell the stock on anyway. So once it starts to get bigger than this, that's the reason that the scale changes. Is do you really want the chart to kick you out just because it moved $6? Well, probably not. You'd like to stay in a little longer. So in this case, we're actually making a series of lower highs and lower lows, and we've made a new low. So we had a column of O's. Now we've made a lower low. So this is actually on a sell signal and would be until it gets back above $204. So it needs to get 204.00 in order to make a higher X. And you can see then we'd be right at resistance again for this X. So there's some resistance that is formed up around this 200 level on Netflix on a PnF chart, but we were in that situation before and we blew right through it. Okay, so you get the concept there. Now, if we go to Caterpillar, and the reason I go to Caterpillar is just because the price is at a different level. Here's the 137 level, but you can see down here at the $100 level, the stock was 96, 97, 98, 99, 100, and now it goes to $2. So depending on the price of the stock or the index or whatever you're looking at, the scale auto adjusts, and that's really important to remember. But what this chart is telling you is back here you made a higher high in April, so you had a declining column, you had lower lows. All of a sudden support held right at the bottom here. This is the major uptrend for Caterpillar, this blue line, and you can see we got right here, we started to make a higher X. So this is on a new buy signal. We pull back, we make a higher low in O's. So we're still on a buy signal, even though we're on a column of O's. And now we break out to new highs right up here. So not just higher than this, new all-time highs. We go up, we roll over. This is May. Here's June. And in June, you can see that we're making new all-time highs. July, we only moved up $2, but it was enough to give us another X. And in August, it was higher, September higher, October higher. And then we got the word boo written up here, which is just, it doesn't mean anything. This just happened in November because B is November. And then you've got the two O's. So at this point, you're on a downward trend, but you're still on a buy signal. It would have to go all the way below this O to get a new sell signal. We're not going to do that. It would probably come down, rattle up, and make I'll call it a low somewhere up here. It would rally and then fail to rally again and then come down and make a lower low at some sort of level. But at this point, if it went straight back down, it would have to go all the way below $96, 96.00 to make a lower low. It's at 138. it's going to be, that's not going to happen. So the way you would expect it is something like this, where it rallies up and it starts to struggle, and then it starts to make a low, rallies again, and then makes a lower low. And that would be how you would finally get on a sell signal on the stock. So it's important to realize after a stock makes a long run up, it actually has to make a column of O's, another column of X's, and then a lower column of O's to go on a sell signal. Okay, let's get into a couple of other things. I want to show a couple of other stocks. Actually, let's do oil first while we're here on the daily. And so here's WTIC. And the point I want to make on this chart, you can see how it's quite dramatically different in shape than all the others. So in 2 years, the stock has done, or the crude has not done much, and basically traded in a real sideways range with the major lows back in 2016. Recently, we broke out to a new high. And when we broke out to that new high, you're going to roll over a 3-box reversal would give us $54 even before the price would actually revert. And it wouldn't go on a sell signal until it got back here below $46. So it would have to be $45.99 or sorry, $44.99. It would have to get to $45 even to make this lower low. So right now, crude is very much in a bull market, and any sort of pullback or even column of O's would still be in a bull market as long as it stays above $45. Hopefully that makes sense to everybody. The point that PnF charts basically help you with is when you start to make higher highs and higher lows, you're in an uptrend, and that is very obvious on this chart. So this blue line is automatically drawn when you go above the previous red line. So this is a downtrend here. And then this X here is trying to break out. See how it broke out here? It got into the line, but not above the line. Well, here it's slightly above the line. That automatically makes this blue line drawn. And the moment it goes above, so it comes down, makes a new column of O's. It's now made a higher column of X's, not just above this previous high, but above these highs. So we're now on 2-year highs for crude oil, and we're in an uptrend, and support is at $47 would be the blue line. And obviously if that blue line broke, that would also be a sell signal based on this last O. So really simple methods to look for support and resistance. Okay, here was horizontal resistance around 51. We tried to break through, spent a little bit of time. We actually went on a sell signal when this column of O's was formed, and have been for, I'll call it through the summer, April, May, June, July. And now we're breaking out to the upside. So as you look at these charts, it becomes pretty clear where is support. Big support at $43, a sell signal at $45 based on this O and on this blue line. So the major trend is up for crude, and we're at new highs. So we're in a bull market on crude until that chart changes. And that's how PnF would record that. Now, let's just quickly look at a couple of other charts, just some of the oil companies, because oil's interesting right here. Here is ConocoPhillips, and you can see it took a little bit of work to reverse the trend back in 2016, broke this big red downtrend, made higher highs, then made lower lows, made higher highs. At this point, it didn't make lower lows. It made a low here, the same low here, even though it's not an O, it's just telling us this was the month that did it. And this is another O. So there's major support at $43 for ConocoPhillips. It rallied up. Now it's in an intermediate downtrend, or a short-term downtrend, but we're still in a big bull market because we're above these blue lines and we're above the previous low. So at this point, it's still bullish. Now, if we go to Apache, the chart isn't as bullish. So this is still in a downtrend on a big picture. And you can see we've got rising O's, but we haven't got a column of X's that goes above the previous column. So you're still on a sell signal. Now here, you briefly got a rising X, and then you immediately went and made lower lows. So this area here from $50 to 46 is now a pretty important area of consolidation. And as the stock tries to get back through this area, price is currently below this previous column of O's, but hasn't made $40 even yet. So until it comes down here, it's still going to register as it's on a buy signal, because Actually, it's still on a sell signal because it's made lower lows, but it hasn't made higher highs yet. And until it makes that higher high, that's the last clue that we're looking at. So it's on a sell signal because it made a lower low here. It's making higher lows, but it hasn't started to make higher highs yet. And so while it's building this base here at $38, $39, $40, this is a pretty important area for the stock. And you can see that if it started to make higher highs above $47, that would be a new bull signal, but it still wouldn't break this red downtrend line. The price would actually have to move back up above it. And this downtrend line continues just on a 45-degree angle. So if the price expanded out to the side way over here by going up and down, up and down, up and down, the red line would eventually catch up to the price, or the price can just accelerate all the way through it. So either way, it's either time or immediate price action that would finally reverse the trend on the big picture. Okay, let's go to something else quickly, like Cabot Oil and Gas. This is a very small company, but the point is here, the red downtrend has been broken. It's made previous high was up here. It made a lower high, then a higher high. Now it's made a higher high above all of this resistance. So this is really starting to move. And the price action is very, very bullish. Now it can wobble around here for a bit, but you're on a big bull uptrend, and you can see we're well off the lows. So much like Apache was kind of sitting under this red line and trying to get a base built to start to work out of, this is the kind of situation you would expect Apache to start to build if it was going to break out into a new bull market. Okay.
One quick one, if you could look at it, because I think it's an interesting question, is GE. Would it have helped the shareholders? Would they have gotten some idea that what would come?
Right here is the sell signal for GE. So it broke below a previous column of O. So just we're going to record this for a longer term review. But GE in the last couple of months has really fallen apart. And so the big picture here on this is October, November. There was no price change in December, so the C doesn't even show up. Here's January, then no change in February. Here's March, no change till July. And all of a sudden, this thing's really starting to unwind. So anyway, the big picture for GE is messy because it's clearly broken that support, and it's way down here breaking this support, but there is horizontal support and resistance at this $17 level. So you might start to hear technicians talk about $17. The next level is down here at $15, and you can see the box size was $1 up here. It's now 50 cents because the price is getting so low. But in this range here at $15.50 or $17 is a big area of support for GE. But we are starting to break its long-term uptrend on this blue line. So a price action at 16.99 would put this $17 box in place and actually put us on a major long-term sell signal like we were back on this side of the chart. So the sell signal would have been here when it made a lower low and broke this brief uptrend. But the big picture bull market investor institutional holdings, we're right on the decisive point right here. If this doesn't hold here, that would change any long-term PnF structure to bearish for the stock.
Awesome.
Okay. And with that, I think we'll wrap up our PnF section. Thanks, everybody. And if you have any further questions, you could send them in and I'll try and answer them on the Commodities Countdown.
All right. Appreciate it. Thank you so much, Greg. That's very interesting. It does, I guess when you look at it, I'm not I don't really follow point and figure. So, as I was following along, I was noticing a couple things. And there was one question that did come in, and I kind of thought the same thing. And that is that the point and figure, a lot of times it doesn't give you that buy signal until you get the breakout. So even if you're in an uptrend and it pulls back, I mean, normally what I would be looking for entry is a pullback to, say, a key moving average or something. But that could be when those O's are going in. So it seems to me like the point and figure is really for someone who is looking to accumulate on strength. Is that a good way of putting it?
It works very well. Commodity traders really like it because they don't buy it until it breaks out and they sell it when it breaks down, and they don't mind the price oscillating in a range. Whereas if you just picked, say, the 200-day moving average or the 50-day moving average, which works well in commodities, above the 50-day you own it, below the 50-day you don't. Well, that could be a one-day decision. Just it could oscillate back and forth above the 50 every day. But in the case of a PnF chart, when it goes on a sell signal, it's had room to move, and if it actually breaks down, that's a sell signal, and you're going short the market until that trend changes. So,
Okay. Yeah, it looks to me like GE, because it's not a real volatile stock.
yeah.
You can go down to the bottom and you can see that this point and figure chart is covering many years.
Oh yeah, 10 years. Yeah.
Because you're just not getting too many $3 reversals
That's right.
in both directions. So if you get a stock that's really not that volatile, my guess is that you'd be better with an interval that's less than $1, maybe 25 cents or 50 cents, like it drops to as you get down below the $20 level.
Yeah, and on there's two things here. One is that you can, for some reason I can't scroll. I think I've zoomed in too far on the chart. Let me just zoom out a little bit. Oh, I think I clicked on it too much. Okay, let me just go grab a different one here. I've got settings that are set up here. So this is Barrick Gold, and the one thing that you can do. So this is a daily chart, but on the bottom here, you can change this box reversal size. You can change it from traditional, which would have been what we were on before, to a percentage. And then you can set the box reversal size to 1% or 0.5% or whatever you'd like. And now, again, I've set this up at 60-minute. And the reason for that is if you want to trade more short term, obviously that scale's not going to work. If you want to trade more short term, you're not going to wait for a new buy signal off this huge downtrend on a daily chart. You would look for a new buy signal on the weekly chart. And at this point, you've got a buy signal with this higher X. But this low, actually, if you make a low here, it's actually below this previous column. So you'll go on a sell signal. But I think, just to give the price room to move, this makes it very clear that this is a consolidation area, just the way the market's chopping around. A break above 1411 or 1418 is going to be pretty important, and I think 1418 is probably what you want to see. So you'd actually, if price on Barrick Gold got above 1425, you'd be interested in going long the stock, because you'd be in a new uptrend. Okay. And so and you're in one right now, but the price action is trading below this previous low, and the box looks like 7 cents. So the box size here at 1383 would actually give you the low. So you'd need 1382 or less to make this low here. When that starts to come in, that would be that would change it to a sell signal again, because you'd have made a lower low. But so you're right on the border. You could either trade against this low, because your stop would be nice and close, or you could trade against waiting for a new breakout at 1425 and trying to trade it to the upside.
Yeah, the one thing I have to say about point and figure, we had Greg Morris on the other day, and we really talked a lot about discipline and sticking to your plan and so forth. The point and figure does give you clear buy and sell signals that you can follow without having to try to make excuses and so forth. I mean, you're getting either clear breakouts or breakdowns, and so those signals should be watched.
Yeah, and the other thing that you can do on this, see this is high-low. The other option you have is close only. So close only ignores the intraday data, and it just says what happened, or it ignores the intra-hour data, and it only says where did it close for the 60-minute period. And so you can use close only, and it'll help remove even more noise. So no intraday highs and intraday lows. It just takes the closing highs and closing lows. And that's a pretty important distinction. If for a beginning trader, if you just want to trade very clear breakouts, you would set this to close only. You might use 60-minute still or daily, whatever your time frame is. The important thing is that when you're starting to make higher highs, that gives you a tradable breakout. And in this case, you're on a buy signal and you're right at the lows. So this is a nice place to trade against, because you're on a buy signal and you have horizontal support and resistance right here. If you start to break down, you're going to sell the stock and you're out with very little loss. If you buy the stock on a buy signal and it turns and goes higher, you've got in right near the absolute low, and you've got lots of upside ahead.
Awesome. All right. Well, I want to thank you, Greg, for coming on and sharing that point and figure segment with us. It was very enlightening for a lot of folks, I'm sure. And I know we're going to have you back very soon. You can share some more thoughts on energy and commodities and things that you watch so closely. But thanks again for all of your input here today.
Yeah, and I just want to point out one more thing on here is that in the predefined scan results, so on your homepage, you can go down and have your predefined scans. And in predefined scans, there's a lot of point and figure patterns that are here. And these are triple top breakouts. So that would be 2X's, and then the third column goes higher. Spread, triple top breakout, it had a brief gap in the middle. Ascending, the X's are continuing to climb. So you can see these are bullish patterns, how many there are. You can click right on here and it'll actually list all the stocks that have that breakout. Now, it could have broken out months ago and it's still on a triple top breakout. So it's important to remember that it's not just, it didn't just happen today, but you can change the scan up at the top of these. When you click on the results, you can click here to edit the scan, and you could set it up so it just broke out today, and that would be a better tool. But go in and look at these predefined scans. It gives you a really nice look at PnF charts and shows you some of the trends that are breaking out. With that, I'll wrap it up. Thanks, everybody.
All right. Appreciate it, Greg. Also, just want to let everybody know, I mean, if you're new to point and figure and you're going in here, I would, maybe paper trade or kind of look at it for a while. I would not just jump in until you fully grasp and understand what your risks are and, what you're looking for in those trades. So, but that was a great presentation. Again, thanks a lot to Greg. And he will be joining us again soon. He's promised us that he'll come back from time to time, and we love to get his thoughts on the market. Now it is time to move on to the 10 in 10, and we will get into the what would you do and do some blog highlights after the final market update. But Aaron, if you're ready, why don't we just go ahead and jump into the 10 in 10?
I think that's a fabulous idea. We did say that we would start with HYG, high yield corporate bonds, I think.
All right. HYG, we do have an uptrend in play. I do like the fact that we bounced off or maybe just above the recent low. So it is still in an uptrend. And an uptrend is simply defined by higher highs and higher lows. And you can see the last time we had some selling, we got down to about the 86 area, just above. And you can see that the low that we had yesterday was just above 86. So I think we're still in an uptrend. I am concerned about the level of volume that came in on this recent breakdown. I think the first key test is going to be this declining 20-day moving average. If you see that we can't get through there, and then we break back down below this price support level, that to me would be very bearish. But until then, this is your support level down closer to 86.
All right. Sounds good. Let's go ahead and look at X, which of course is US Steel.
Yes, X, I'm still waiting to see if we can get this breakout. I mean, we've tested it. We had a false breakout recently. But for me, if I'm just, trying to keep an eye on the stock, I think it's pretty obvious. First of all, there was your prior low. And then you can look and see we had a prior or a reaction high since this gap down. This is the highest level we've gotten to, and we just had a false breakout. So I'd really like to get through, let's call it 28.75 or so, and then the big price or the big gap resistance level that we're going to be looking at. It's up near 31. That's where we were when we had this massive gap down. So if you get back up to this level, you're probably going to run into some selling. So these are the areas of resistance. We are in a nice uptrend. I expect it to continue, but this is going to be a key area to watch. A break above 31 would be very bullish.
All right. Next one I have for you is MYGN.
All right. Is it Myriad Genetics?
Mm-hmm.
Okay. Yeah, this is exactly what I was just talking about. We had a big gap down, heavy volume, and notice today's earlier high right to the top of that gap resistance. And right now, that is where it's failing. So for me, I have to see it get back above that level. And so what I'm referring to is right there. This is where we had gap down, increasing volume, very bearish red candle. We do still have a trend in play to the upside. So if we can get back through 34, I think that would be doing a lot to hopefully resume this longer term uptrend. But this is a critical area because of all the selling that took place from that $34 level.
All right. Next one is STM. And that, microelectronics, ST.
Yeah, ST Microelectronics in a good space. This, I believe, is a semiconductor. Gap support, the top of gap support to me is the big level. We continue to trend higher, very, very heavy volume. You see great volume during this uptrend and in that gap. So for me, the big level is going to be that rising 20-day moving average and then the top of gap support. So those are the two levels that I would be looking for possible entry if this is a stock that you're following. So let's call it between $22.50, $23.
Okay. Next one is for our Canadian friends, ALA.TO.
All right, ALA.TO. Oops, not .o. All right. We are in a nice uptrend. I mean, definitely looking to reverse. I think the trend line is fairly clear. So let me go ahead and just see if we've got exact touches here. But if you connect these right along here, you can see that's a pretty strong uptrend where we haven't closed. We've seen tails go below that trend line, but we haven't closed. And if we grab this line right here, oops, not there. Let's try it again. There we go. This is a pretty nice channel that I would continue to follow. I mean, because you have multiple points on both the bottom and the top line, that to me looks like a very definable channel that I would probably be willing to trade. So to the downside, I think 28.75, that recent low yesterday, I think needs to hold. And to the upside, you can see as we keep moving out in time, this high will continue to move higher. And the key price resistance level is going to be that high back in May, just maybe about 30.60. So it looks like we're headed on a path to test that 30.60 area.
All right. Next one I have for you is Disney, DIS. Interesting level of support right now.
Yeah, I like the way Disney had been acting. Just pull that up here. And I think I had featured the broadcasting and entertainment group not too long ago, saying that it looked like it was trying to reverse. And Disney, look at the volume coming in as we got this golden cross, the 20 moving back through the 50. I think this is a pretty decent area actually on this pullback for entry. I mean, the 20-day moving average is always possible, but we have gone back down to test a key price support area. So I'm going to show right in there. You can see that this was pretty big on the way down, acting as support. And then once we got the gap down, these reaction highs, we've really struggled to get back up through 103, and we just did it on some pretty decent volume recently. And now we're coming back down and testing. So I'm going to say between about 101.25 and 103 is very strong support during this short-term move to the upside. Daily MACD looks much better. I think that we've begun an uptrend on Disney, so I'd be willing to take a shot on it between 103 down to, say, that 101.25 area.
All right. Next one is Expedia, EXPE.
All right, EXPE. Well, I know that Priceline does not like this time of year and has not been performing well. And you can see Expedia also taking a very big hit at the end of October with its earnings report. I can't get behind this one. I think after the gap down on massive volume, the reaction high is up here just about to test that declining 20-day. So for me, the upside in this stock is maybe up to, let's see if I can get this. All right, doesn't want to work just yet. Let's try this again. Oops, I don't know how I got back on Disney. Let's try this again. All right. There we go.
All
okay,
right.
so here was the gap down. You can see the big volume. We rallied back up to about 125 and change, maybe 126. And you see the declining 20-day moving average coming down. I mean, if you wonder about the 20-day, you get into an uptrend and you can see how that rising 20-day moving average tends to provide pretty solid support along the way. The same holds true to the downside. Now, we're not in a bear market, but I do think that with this huge volume gap down on Expedia, I think this uptrend ended, and I would have to see at least volume pick up and a move through the 20-day moving average before I would be excited. So I think this bounce off the recent low actually is starting to exhaust the opportunity to the upside. I would not be in Expedia. I don't like it.
All right. After Expedia, we have Service Corp, SCI.
All right. I skipped one there. All right, SCI. Yeah, this one was actually on my strong earnings list for a while, but I don't know if they just recently, if this is another earnings report or what, but I do like the fact that it broke out. I love the candle yesterday with that long tail to the downside and now moving back up. So I would say, looking at this one briefly, I'd probably maybe think about something like that. I mean, that's a pretty decent long-term uptrend. The recent high is the target in the near term. I think we'll eventually go through, but right here at about 36.40, 36.30, that's a big level. So I think we're going to squeeze in this range, but my expectation would be that we'd eventually break out to the upside.
Okay. Next, CAI International, and then we'll have one more after that.
All right, CAI. Yeah, I think this one actually looks really good. I like these pullbacks to moving averages and to the top of gap support. We're trying to reverse off of that 20-day moving average. So when I look at a chart like this, I tend to look at there. That's the top of the gap. So here was your gap. Here was your very heavy volume. There's a quick, short-term target up at 48. Now, the problem with getting in it here, at least getting in a full position, is that from 36 down to 33-ish, you got $3 downside and about $4 upside. That really doesn't meet my reward to risk. Of course, yesterday's low was getting much closer, and the reward to risk was much better. So it's really about timing. I like the chart here. I like the uptrend. I love the volume trends. It's just a matter of getting in at the right point so that you have a solid reward to risk entry. So I am bullish CAI, but I would prefer it much better if it got down to the top of that gap support.
All right. And the last one I have for you is a telecom ETF, iShares, IYZ. I know we're looking for a bottom here, but this is a falling knife.
Yeah, I mean, it's oversold, and so we're getting a little bit of a bounce here. Nothing that I would necessarily be willing to hold on to for very long. I mean, if I got in because it was oversold and I got a bounce, which I'm getting, I'd be using the bounce to get back out. I mean, this does not look good to me. You can see as we broke into new lows and moved lower, volume picked up on the selling and the MACD moved to fresh lows as well. So normally when that happens, you're probably going to be looking at the 20-day moving average as your support area. So let's just first highlight this, that we're oversold. So a bounce out of oversold conditions eventually is what you're expecting, just like when you're overbought. You're looking for a pullback to get in. Well, if you were thinking shorting, you're looking for a bounce to short. You don't want to short when you're so oversold. So we're starting to get a move to the upside. I think from a price resistance perspective, 29.5, but I'm not even sure we get back there because that 20-day moving average to me probably is going to offer up some pretty stiff resistance here. So I'd be watching that 20-day moving average. I don't like it.
Yeah, and the weekly chart is pretty ugly as well. I don't really see good support, even where it's landed some support just in the last couple days.
Yep.
All right.
All right. So there we go. I know we got a couple more things we want to get through, and one of them is the what would you do?
Yes.
So I'm going to go ahead and pull the chart up here. This is the XBI. And so the question is, looking at this chart, what would you do? Would you be a buyer? Would you be a seller? Would you just simply do nothing and sit on your hands? Look at other areas? Looking at the biotechs. And, the thing is, as you look at this, keep in mind that rotation happens in the stock market. I mean, it'd be nice if everything you bought just kept going up every single day, but that's not the way the stock market works. Even in a bull market advance, there are areas that lag and there are areas that lead. And so certainly we've been seeing some weakness here in the biotechs since the beginning of October. So it's a pretty interesting question. So I'm going to let everybody have just a couple of minutes there to take a look at XBI and see what you think.
Yeah, go ahead and put it in the chat box, maybe with XBI as the first part of the chat, and then I'll try and put those together after I show my chart. So,
and while we're waiting on that and letting everybody respond there, I thought maybe it'd be a good time just to remind everyone that Aaron is going to be doing chart patterns tomorrow. So if you're interested in chart patterns or you want to learn more, be sure to stop by tomorrow and take a look at those patterns. And then next week, also I wanted to mention that next Thursday and Friday, we will not be here. Market Watchers Live. There will be no shows next Thursday and Friday for the Thanksgiving holiday. Of course, the stock market is closed on Thursday, and hopefully everybody's spending some time with family and friends. And then on Friday, there is an abbreviated session. So the market will open on time at 9:30 Eastern, but it closes early at 1 p.m. There tends to be extremely light volume and normally not much volatility. So not a whole lot of reason to have a show that day. So there will be no Market Watchers Live webinars next week.
well, on Friday anyway.
Friday. Yeah.
Yes. And on Wednesday, Tom is not going to be here, and I managed to grab Mark Young from the Wall Street Sentiment Survey. So on Wednesday, we'll be talking a lot of sentiment, how you read it, what's out there right now. So I don't think you'll want to miss Wednesday, or at least go back and look at it if you're traveling to family and friends. So I did pull up the candle glance just so we can look at what's been happening in the market since we last saw it. And really, the basic story is we're just on a rally and continue to make new intraday highs. And look at the Russell 2000. After forming a flag, it's now taking off and has executed it. So, I think we're in a good place for small caps right now. So,
and I think the reversals that we've seen in the market overall, I think the past week or two, it seems like we're going to get some selling, and then we get buyers coming right back in the afternoon. And now today, it seems like a trend day, where you gap up and you just simply go higher the rest of the day, which these tend to be very bullish types of days.
Absolutely. So do you want, I'm going to show my XBI chart because I do happen to have it right here.
Sure.
Like I said, if you guys want to put some comments in, say XBI, and then kind of what it is, that way I'll be able to sort out what you guys are saying, and I'll take a tally on a few of them. But yeah, buy, would you buy, hold, sell, short, basically the two, or just forget about it, just leave it alone. Maybe add it to a watch list. I don't know, but go for it. And I'm going to show you my chart as to what I'm looking at when I look at it as far as my indicators go. I was looking at a possible head and shoulders here that had formed. And of course, that's a bearish pattern. And the expectation, given the height of this pattern, would have taken it down right to this area of support. I'm not so sure we still won't test that area of support. The PMO is now oversold, but it's decelerating, but it's still moving downward. Volume is still very negative right now as far as the OBV, just moving down greatly here. We are seeing a bit of a move up on the scooter, but overall, I think what I would probably be doing right now is if I was holding it, I would probably set my stop right around 80. But since that's really not the question, I would have to say that I would definitely leave this one alone. I don't think that I would take the risk to short it because there truly is an opportunity for that head and shoulders pattern to bust, especially now that we're seeing it price trying to get back above. And at that point, I would say that pattern's busted. But I'd leave it alone because I'd want to know where we're going. And if I was holding it, I would probably tighten a stop.
Okay. All right. I don't know. Do we have other comments before I give mine?
Well, I'm going to go, and while you're doing yours, I'm going to start tallying up some of those comments.
Okay.
All right.
Well, I'll tell you what. For me, I'm going to take the other side of it. I would be a buyer, and I like the reaction today that finally we're moving back up to the upside. But the reason I'd be a buyer, if I didn't know anything else about the market, and I only was looking at this chart, would I be a buyer? I would say no. And the reason being, if you take a look at the recent price high here, back in July, we were up at about 82. We broke out We kind of held it on this pullback, moved to a new high, kind of, maybe we went just a fraction below it here, but basically I would say it held again. And then we broke down here and you can see the volume picking up. So I look at this and the MACD's turned negative, looks weak. So on the surface, when I'd look at this, I'd say, wow, we're probably going to fail at 82 and maybe we will, but I'm going to go on the opposite side and I'm going to look at this as probably a false breakdown. And the reason I say that is that I'm playing by bull market rules. I believe the stock market is not done going to the upside. And if it continues going higher, I don't believe that biotechs are going to be left behind. So I think we're going to reverse back to the upside. I think the key level on biotechs is, or the key thing to focus on is you need to continue to stay in this uptrend, which is a series of higher highs and higher lows. I think if we were to connect, and I saw actually, I cheated a little bit because I saw Arthur Hill's blog article. And that's the reason I picked this one, by the way, because I thought Arthur did a pretty good job here talking about the trend line. And I don't have it drawn quite as well as he does. But the trend line to me is still in play. We're still moving to higher highs, higher lows, as you can see with these highs up here. So yes, in the very near term, I would say maybe it's triggered a little bit of a sell. But I think the longer term picture is still bullish. And the fact that we're still in a bull market, I think biotechs will get healthy again. And I think that this temporary short-term breakdown is actually setting up an opportunity. But time will certainly tell on that one. And I don't know if you have some comments from the chat room, but while you're doing that, I'm going to pull up Arthur's article and show what he had to say about it.
Sure. And a lot of people are kind of where we're at, that it's kind of in a wait and see place. We had definitely the majority, it sounded like, either avoid it or just, stay away. But as far as buying versus shorting, we had more people say they would short than buy. But it was still pretty even, honestly, across the board. So it's just one of those that I think everybody has a different opinion on based on their particular strategies. So kind of an interesting choice, actually. What does Arthur have to say?
Well, here was the chart that he put into his blog article that just came out. And so he covered off a lot of different areas, and biotechs were one of them. I thought this was pretty interesting. I think when I was connecting my uptrend line, I only had this February or late January low. I don't think I had the one that actually went that printed at the end of December of 2016. But if you take that one,
hey, Tom, I'm sorry. Can you make that chart bigger?
Yeah, let me.
There we go.
Let's do that.
Yeah, I can't see very well.
No, that's all right. It was actually, I had just clicked on it in the article, which is one of the nice features at Stock Charts, by the way. You can click on any of these charts within our blogs, and it will bring up the chart real time. So you can see right now, 1:16 p.m. here. This is the way the XBI looks. And if you scroll down, you can then see the settings so that you can mirror the charts if you'd like. Or you can save, the charts into one of your lists. But anyhow, you can see the lows, and I thought Arthur did a really good job, and I think he probably could have even grabbed this line and drug it up here, because I think we're in a channel throughout 2017. And so sometimes you get these what looks like breakdowns to the downside, and then we just resume with another big move to the upside. And so I think right now, this period, because we had such a big advance in August and September, I think that this short-term downtrend that he identified and highlighted, I think is going to break to the upside. And when it does, I expect another big move in the biotechs to the upside. So I'm going to say it's a buy, and I'm going to put a stop in probably below 78, because I do think that this trend line, along with the recent low, is pretty important. I think that probably, from what I'm seeing in the market probably just put in a short-term bottom, and we're starting to rally again. So I would not want to see the XBI or biotechs in general take out their lows that they just printed here within the last couple of days. So,
all right. So you're a buy. I'm going to put myself down as leave it alone, because it just doesn't look good enough for me, but it doesn't look bad enough either.
Yeah. And actually, that's not a bad strategy sometimes. If you're not comfortable with an area, just not getting involved in it's probably the best thing, because if you get in and you're not confident in that trade, first sign of weakness, you're going to start panicking.
Mm-hmm.
So the only thing is, if you do get in, my thought process is that you want to make sure you keep a stop. So if you see something you like I was just pointing out that trend line and the fact that we had that price supported at a certain level, you want to stick to that. So if that's your support level, if it breaks, don't say, well, you know what? If we go back another few months, I can find, this support level over here, which is at 75, that's the game. And then, oh, by the way, we broke out here at 72 and we haven't gone back to test that. And by the time you know how the game
Exactly.
works, you get in 82 and before you know it, you're at 72, wondering how you had such a big loss.
Yeah, exactly. But it's going to go back up. It's going to go back up.
Yeah, so I think that the fact that everybody was kind of on different sides, I think that's what the market deals with. I mean, I think that's a snapshot of what we're looking at in the market and
Mhm.
all the different feelings when you're looking at a sector that's been pulling back. It always feels good when it's going up every day, but when it
Mhm.
starts pulling back, it starts sending you different messages. And so I find it interesting that everyone is kind of mixed on what to do with this group.
Absolutely. I think everybody's usually pretty mixed about what they'll do about any stock. Somebody in the chat room says we need to start calling you Biotech Tom.
Is that Greg? Is Greg Schnell in the room?
No, it's not Greg.
Greg always gives me a bunch of grief because I like banks and biotechs.
That's right. The BBs.
Yeah, there's still a long-term uptrend in both of them, so I'm going to stick with them. I don't necessarily feel like they're always. In fact, I didn't talk about biotechs for a while. I mean, they got very overbought, and they needed a pullback. But I think now that they've come down, I think the 82 level was pretty big on the XBI, so I'm a little surprised. I think if I had traded it short term, I probably would have gotten stopped out as we broke down below it.
Mhm.
After looking at what Arthur wrote and just knowing that I feel like we're still in the midst of a bull market, I believe this is going to reverse back to the upside.
Right. And they are pretty volatile, those biotechs, at least some of the individuals. Somebody had asked in email, I believe. So if you have a sector spider or ETF, how do you get to the components?
Well, there's a lot of different ways. Sometimes I'll just do something like a Yahoo.
Mhm.
So, for instance, let me pull up Yahoo here. Hopefully, it won't start playing some video.
I know, right?
I hate going to some of these different places, but let's pull up the XBI.
Yeah, see, it's already trying to play.
It's trying to play something. I'll just get rid of it.
Mm-hmm.
Holdings. And then you come down and you can see the top 10 holdings here, ALNY, EXAS. And I know on that chart that I showed earlier of Arthur's, he had them listed. That's some extra work that he had to go through to list those holdings, the percentages. But the one thing that sticks out to me is that the top 10 holdings is only 23% of the total assets. And you can see that ALNY at 3.18% is the highest holding in here. So the individual stock risk is not that great. So if I was going to get into something biotech related, I would like an ETF like this.
Mm-hmm.
If you get into one that's got, it's heavily weighted toward 2 or 3 individual stocks, then you really should be looking at the charts of those 3 stocks. And if you don't like those 3 charts, then you probably don't want to be in that ETF because it's going to be directed to a large extent by those 3 particular stocks. But here, that's not the case. You got a pretty widely diversified biotech holding ETF. So this isn't too bad.
All right.
All right. I don't know if you had any other comments on the blogs. I did quickly bring up the blog that Arthur had just written, and I thought it was a really good article. So let me pull it back up again real quick and just show you. You do have to be a member to get this blog. This is one of those highlighted blogs. So if you want to get information from John Murphy or Martin Pring or Arthur Hill, you're going to need to be a member. But this is certainly worth the subscription by itself. This is a very, very well written article where Arthur is talking about the bond market and the 10-year Treasury yield, and he's kind of identifying some key support zones. And I tend to agree with that as well. I think that that's really critical in the short term that we hold on to this to the recent lows in the 10-year Treasury yield. Because if we break down, it means that money is rotating back toward Treasuries, and that usually is not a great sign for equities because every dollar going into the bond market certainly cannot go into the stock market. But then the junk bond update, I don't really follow the junk bonds too closely, but if you do, you may want to read through that. Here's the big banks, and I thought this was an interesting chart as well because he was mentioning the reversing candles, these bullish engulfing candles. This is on the XLF, and then if you go down below, you can see some of these similar looking candlesticks on many of the key financial stocks. JP Morgan, and then you've got Goldman Sachs hitting support or getting close to support and reversing out of there. And then a big move up on Bank of America. I think some of that may have been the, I read that Warren Buffett was reiterating his stance on Bank of America, that I think that may be his largest holding. And so, of course, everyone likes to hear that Warren Buffett loves their stock. And then Citigroup here, which I think has just been consolidating, but continues to be in an uptrend. So I think Arthur there is looking for maybe a breakout eventually out of that wedge formation. And then copper, here's a bullish wedge. I mean, it just goes into so many different things. The biotechs, which we just talked about, and some more information here, some competition for Netflix. Anyway, this is a lot of information that he's giving in this one article.
Yes.
Disney, which we talked about earlier. So anyway, great article. I thought it was done very well, and just one of the many great articles and blog authors that we have at Stock Charts.
Yeah, I wanted to just point out one thing too on the blogs page. Hopefully you can see it. You did mention these ones in green are members only. Well, a bit of a hint here. I used to have a members only blog called the Decision Point Alert. But when we started the show, rather than me having to keep up with 3 different blogs, they went ahead and took that one away. But you can get those same DP alerts in the Decision Point blog. I don't write them every day like I did back when I had a Decision Point Alert blog. But anything that starts with DP alert is going to give you basically what everybody had to pay for earlier. So I just wanted to point that out. And Carl's weekly wrap, same thing. Those used to be in the paid blog. So you can get what used to be paid content now for free. So enjoy that. But with the Decision Point alerts, I follow a sort of like you do in Trading Places in the morning. I follow pretty much the same format. And what's great about this, especially if you want to know more about DP indicators, is that whenever I write a DP alert, I always put in the indicators and I give you an idea of what they're doing. And then I tell you why they're different now and what's going on. So, and that's every time I do a DP alert. So you'll get a much better handle on how to read our indicators. So I just wanted to point that one out. I know we're getting ready to wrap it up here soon.
Yeah, one final thought that I wanted to just share with everybody. When we talk about the dollar, and of course the dollar has a relationship that you really want to keep an eye on with many of the commodities, areas of commodities, especially gold. But when you take a look at this chart, this has a big impact on the direction of the dollar. And this is the 10-year Treasury yield, U.S. Treasury yield, minus the 10-year German Treasury yield. So it doesn't just tell you whether or not U.S. yields are rising, but it tells you whether they're rising faster than yields in Europe, especially in Germany. And so when you look at this, a lot of times you'll see the U.S. yields going up, but the dollar doesn't follow suit. And Economics 101 tells us higher interest rates tend to strengthen the dollar. Keep in mind that now that we're such a global, that the global markets are so important, it's not just about U.S. yields. It's how the U.S. yields are performing relative to other yields around the globe, and especially, I believe, in Germany. So that's what this chart is measuring. So when we've had this recent pullback in the U.S. Treasury yield relative to Germany, and then we pull up, say, the UUP, which tracks the dollar, you notice that the dollar has been pulling back recently. Even though the yield hasn't pulled back that much and we've kind of been fluctuating, keep in mind the difference there is what's so important. So what are you looking at as we go into the close today, Aaron?
Well, really, I want to see what's going to happen with my short-term indicators, because, they were already starting to turn up and then they turned back down. I'm curious how this rally is going to affect our indicators coming up today. So I will be writing about the S&P 600, Russell 2000 today in the Decision Point Alert blog. So keep an eye out for that.
Awesome. I do want to mention one more time that Aaron will be doing chart patterns tomorrow. So make sure that you are in for that. A lot of good information there. Also, next Thursday and Friday, no Market Watchers Live for the holidays, but we'll be back that following Monday, and we will be here Monday through Wednesday of next week. I want to thank everybody for stopping by. Really appreciate your support. Please complete the survey as you exit the show. We love getting your feedback, and we use your comment and survey responses to help shape future shows. As a reminder, Market Watchers Live now airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. See you tomorrow. Happy trading.